morning students. Today we shall discuss about the problematic manner in case of the admission of a partner. Let us move to take one to section C question, section D question. So according to this admission of a partner. So this question belongs to 12 marks question for section D. They will ask. So compulsory question they will ask the examination point of view.
Name and survey. Are partners sharing profit and losses in the ratio of 3:2. Their balance sheet as on
was as follows. Balance sheet as on
31st
March 2019. So let's withdraw for the balance sheet columns. So here balance sheet columns will come liabilities amount, assets amount. Like this manner we have to create a balance sheet. Assets amount, liabilities amount. So we should write one by one headings and the liability side.
Creditors 20,000.
20,000.
Bills payable 6,000.
6,000.
General reserve
General reserve
4,000.
4,000.
Capitals Anil Sunil 40,000. 30,000. Assets
Next
cash at bank
Cash
at bank 5,000. Debtors 18,000. Stock 17,000. Buildings 30,000.
30.
Furniture 10,000. Machinery 20,000. Machinery 20,000. Both side total 1 lakh 1 lakh. 1 lakh 1 lakh.
Let's move to the adjustments.
Next on
Adjustments on
1/4/2016.
1/4/2020.
Sorry, 19. 1/4/2019. 20. They admitted Vimal, he a Union on the following terms. On the following terms. On the following terms. First adjustment. He bring rupees 25,000 as capital and rupees 8,000 towards goodwill for 1/6 share in the future profits. Full stop. Goodwill amount is retained in the business. Goodwill amount is retained in the business. Full stop. Second example. Depreciate machinery by 10%. And furniture by 5%. Third adjustment. Provision for doubtful debts. Is maintained at 5% on debtors. Next, fourth adjustment. Appreciate buildings by 20%. Next, fifth and last adjustment. Provide rupees 400 for repair charges. Prepare revaluation account. Partners capital account. Bank account. Goodwill account. And balance sheet of the firm after admission.
Okay, so this is the question. This question belongs to 12 marks question for section D in the examination point of view. This will be the second question we will ask in the examination point of view. But so before going to discuss about the particular solution of this question, we have to read the question, we have to understand the question, and we have to divide the transaction where they are affected while preparing the new balance sheet of the particular question. So before that, first we have to understand what the information they are given. and Sunil are the partners. So Anil and Sunil are the old partners. Already they have established a particular business, but they have admitted one more person during that time. How their accounts will be bifurcated, how their accounts will be fluctuated, and we have to imagine that one, and we have to prepare a new balance sheet after admission of a particular partner. We have to separate this one first. So here Anil and Sunil are the partners. They are the old partners, sharing profits and losses in the ratio of, so proportion they are given. So in their future, any profits or any losses they have to get, they are distributed according to this ratio, 3:2. That is 3/5 for one partner, 2/5 for one more partner. They have to distribute it according to this manner only. So this is very important information which is available in our question. In some times this proportion is not given, means we have assumed that the partners are the equal profit sharing partners. That means they are sharing profits equally, half of portion, 1/2, 1/2, 1:1. We have to assume that one. Suppose proportion they are given means based on that we have to distribute it. Ratio they are given means based on that ratio we are going to distribute the profits and losses of the firm. Their balance sheet as on 31st March 2019 was as follows. So they are given information about the particular 2019 information. So they have to admitted one more partner in future, that is 2020. During that time, how the balance sheet will be located, that information we have to prepare and we have to show. We have one important note, we have to assume that the entire partnership account should be based on imagination, assumption. So if a partner entered this, the accounts will be like this. If the partner will be retired, the accounts will be like this. If the company is closed, dissolved, the accounts we have to close in this manner. Like that imagination we have created in our mind. So here also some important information is given. So balance sheet, they are given balance sheet as on 31st March 2019. But in this balance sheet, some transactions will be come to the account, some transactions will come to the another new balance sheet. So first we have to separate this one. So balance sheet headings they are given: liabilities, amount, assets, amount. Always liabilities come to our left hand side and assets come to our right hand side. So in the left hand side information, creditors, it is belongs to liability. It will come to the new balance sheet only. It won't affect it to the account. Bills payable, it is also a liability, so it comes to the new balance sheet as per the same heading only. General reserve, so general reserve, the name itself indicates. Reserve is nothing but we should keep some amount for the future problem. So this reserve has been maintained by these two persons only, not for the new partner. Old partner has maintained some reserve, so this reserve belongs to the partner, so it will come to the partner's capital account. So we have to distribute it according to this ratio for old partners only, not for the new partner. And capital, so capital belongs to the partners, it will come to the partner's capital account. So like this we have to distribute the liabilities. Let's come back to the asset side. So in the asset side, cash at bank they are given. So cash at bank is a current asset. So in the question they have to identify that prepare bank account. So if that information is not given into the question, means this amount directly come to the new balance sheet. But they are given, we have to prepare bank account, means this transaction will come to the bank account as opening balance. Debtors, it is an asset, it is come to the balance sheet. Stock, asset, it is also come to the balance sheet. Building, fixed asset, this is also come to the new balance sheet. Furniture, this is also come to the new balance sheet. Machinery, this one is also come to the new balance sheet. So first we have to distribute the transaction, we have to divide the transaction where they are affected before making the solution. So this kind of the clarification we have to get. After that we have to move to the adjustment. So here each adjustment we have to record it twice, then only the new balance sheet is going to balance. If sometimes one transaction recorded in once, another time we are not recorded, we have to forgot to record, means definitely it will become a imbalance of position statement, so they won't get the equal value. Let's come to the adjustment. So here each and every adjustment we should record it twice also. So here on 1st April 2020 they admitted Vimal. So Vimal is the new partner who is entering into the partnership firm. So Vimal into a partnership on the following conditions, on the following conditions both are same. So Vimal is admitted as a partner into the partnership firm on the following conditions. Which are those conditions? They are given 5 conditions. Based on these conditions, we have to prepare. These are the 5 accounts we have to prepare. So adjustment number 1, what it will say? He brings. He is nothing but Vimal. Brings. He will took over to the business. Brings rupees 25,000 as a capital. If you want to join as a partner into the partnership firm, Vimal has to pay the minimum capital is 25,000 that he is given. So here this 25,000 is given to the Vimal. So and as a capital and 8,000 towards goodwill they are given. So 8,000 towards goodwill. So these 2 transactions will be taken has bring by Vimal only. So here the entire transaction belongs to partners capital account. So in the partners capital account, where we have to record it is under credit side we have to record it, because this is the opening balance of Vimal and he has to pay 8,000 towards goodwill. We should recognize in the heading to by bank account, because whatever the monetary transactions we have received from the partnership business, so that entire transactions we have to record it through bank only. We are not taking a cash transaction, we are recorded bank transaction. It will be considered as a legal transaction. It is a true transaction. And one more time we have to record it. So these 2 values again we have to record it. So suppose bank account is not given, means we should not record it with the bank account. Goodwill account they didn't ask, means we won't record it the goodwill account also. Directly we have to record it the new balance sheet. So now the second transaction we have to come to the bank account and goodwill account. So here 2 places, out of that any 1 places we have to record it the transaction. So first adjustment we should record it twice. One is partners capital account credit side, bank account and goodwill account we have to record it. Bank account it will come to the bank transaction and goodwill account we have to transfer, or else just we have to show it to the bank account only. The entire balance will transfer to the new balance sheet only. So this is the first adjustment. Next, adjustment number 2. It will say that depreciate machinery. Depreciate is nothing but decrease in the value of machinery. Why the machinery value is decreasing? What is the reason? Is because of the wear and tear of the particular asset, because of continuous use of the particular asset, the asset is reduces its original value, it reduces the original price. That redemption will be called as a depreciation. For example, for depreciation, so we have to purchase a particular motor car from the showroom, its cost is 10 lakh rupees. While we have to purchase it, we are paying 10 lakhs rupees as the investment of a particular car. We are using the car for 1 month only, we are using 30 days. After 30 days, we are not satisfied about that car. We want to exchange the car. We want to purchase one more car. During that time, we have to sell the particular asset, particular car. So whenever we are going to say, we won't get the rupees 10 lakhs. Instead of 10 lakhs, we are receiving only 9 lakh rupees, because 1 lakh rupees is the reducers. Why the price is reducers? Means because of the usage of that particular asset, usage of the particular car, the value is going to be reducers. Like that also, in case of the business, whenever we have to purchase the machineries, if cost is high, after using the machineries, after using the any fixed asset, it reduces its value, it loses its original value. So that reduction is known as a So how much they are reducing is depreciate machinery by 10% and furniture by 5%. Both are the expenses to the company, because once our cash will be reduced, that will consider it is an expense. If we get more money, means that is an income to us, but our asset cash value will be reduced. Our asset value will be reduced, it should be considered as an expenses. So expenses belongs to the revaluation account. So on the revaluation account, which side we are recorded? Under debit side of revaluation account we have to record it. And one more time, where we have to record it? Under balance sheet we should deduct the decreased value, what the value in the beginning and what the value will be reduced, and finally present here what is the exact status of that asset. We have to record it into the new balance sheet. So we have to record it once in the revaluation account, another time is the balance sheet. We should deduct the difference value what we have to find out here. That is adjustment number 2. So come to adjustment number 3. Provision for doubtful debts is maintained. In case of the business, debts are common. So because without debts it is not possible to run the business. So without business, in that business, doubts may be arises or may not be arises. So here doubtful debts, whenever we have to make the credit sale, sometimes the purchaser has to pay the full amount, lump sum amount they have to pay. Sometimes they will do some kind of the balance amount. Whenever the balance amount they have to repay, they will be refunded some return commission. That return commission will be considered as a debts. Non-paid amount, whatever into the business, that non-paid amount will be considered as a debts. Is maintained at 5% on debtors. So that means already we have a debtors. Some other persons may have to pay money to the business. In that money, 5% money may be or may not be recovered. They are given. So may be or may not be recovered. That is the expenses to us. So expenses means it will come to the revaluation account, debit side, and balance sheet. We should deduct the value. So adjustment number 3 also we should record it twice. Let's come to adjustment number 4. Appreciate buildings by 20%. So here given appreciation is nothing but increasing. If the asset value is increasing, means that is an income to us. If the asset value is decreasing, means that is expenses to us. So already we have discussed about the expenses. Means it will come to the debit side of revaluation account because it is an expense. Appreciation means increasing our asset value, means that is the income to us. So these incomes and expenses always we should record it in the revaluation account. So revaluation account, credit side we have to record it first, and later it should be added to the balance sheet. So what is the original value of buildings plus what is the percentage of appreciation? Both we should add it, and what is the present value of the building we have to record it. So that is the adjustment number 4. It is also recorded twice. Next, adjustment number 5. Provide rupees 400 for repair charges. Provide is nothing but pay. How much? 400. For what purpose we are paying? Repair charges. Whenever we have to maintenance of the repair charges, means it is an expenses to the company. The company has to pay money to the particular person. So it will be considered as an expenses. So first we have to record a revaluation account, debit side, and balance sheet. Under liabilities we have to record it. Particular liabilities only we have to record it, because it is not an asset. It is not a particular liability, fixed or non-fixed liability, but here it is an expense. So once we have to pay, means it is a liability to the company, so that will come to the liability side of the one more balance sheet we have to record it. So these are all the adjustments. Based on this adjustments, we have to prepare 4 accounts. So number 1 is revaluation account. Let us know what is meant by revaluation account. Revaluation account, it is an account where we recorded revalued of assets and liabilities. Whatever the previous value, what is the present value, what is the changes it should be occurring to the business, that changes we have to record it in a particular account. That account is known as a revaluation account. In this account only we have to record a revalue of assets and liabilities. So that account is known as a revaluation account. How this account is prepared means based on the adjustments only we have to prepare revaluation account. We won't prepare the account based on the balance sheet. We should prepare based on the adjustment. Revaluation account is totally always depending upon the adjustment. Number second account is a partner's capital account. So if the new partner is entering into the business, how their accounts will be there? What is their present account balance will be available into that business? We want to know about that clarification. We have to prepare the partner's capital account. This is the second account. And third account is a bank account. In this bank account, in the beginning, how much of bank balance will be available for the business? After admission of a new partner, how the bank balance will be changes, whether the balance will be increased or decreased. What the things will be happen, we have to record it. That account will be called as a bank account. And one more account is a goodwill account. In the last class itself, we have to discuss about the goodwill. Goodwill is nothing but good name and reputation of a business which is earned into the business for the future profits. So if you want to get the profit, we create a good name. While creating the good name, it is not an easy task. For creation of that goodwill, we have to do lot of hard work, lot of struggle we have to face. Then only we will get a good name and reputation. So for that sake, they will fix some value. That value is rupees 8,000. So in that 8,000, how we are going to utilize that value? We have to record it in that account. That account will be called as a goodwill account. So these four accounts we have to prepare. Based on these four accounts, we have to prepare balance sheet. Balance sheet is nothing but position statement. This statement when we have to prepare it after admission of a new partner. If a new partner is entering into the business, so during that time, how their balance sheet will be available into that business. Based on that assumption, we have to prepare the balance sheet. So here, one important note we have to assume that one account is a link with another account. Revaluation account is a link for the partner's capital account. Partner's capital account is a link for both bank account as well as the goodwill account. And these three accounts will be linked to the particular balance sheet. Based on this assumption, we have to prepare the exact 12 marks question under admission of a partners section D. We are going to be asked. Next, we have to move to the solutions about the particular situation only. So first account they will be says that revaluation account. First we have to draw the columns for revaluation account. Based on the adjustment, we have to prepare revaluation account. So here, first revaluation account. Revaluation account. So the columns of revaluation account is very simply they have written. That is particulars amount, particulars amount. So first heading we have to write debit and credit. These are the two pillars of the accounts. Without this one, it is not possible to prepare the account. Particulars amount, particulars amount. Particulars amount. So first we have to get a clarification. So revaluation account is totally depends upon the adjustments only. Based on this adjustment, we have to prepare a revaluation account. So already we have to divide the transactions where the transaction will become. Adjustment number 1 will say that he brings rupees 25,000 as capital and 8,000 towards goodwill for 1/6 share in future profits. Goodwill amount is retained in the business. They are given. So this entire transaction adjustment number 1 belongs to the partner's capital account. But we are preparing revaluation account. So adjustment number 1 will not affect it to the revaluation account. So first adjustment will not come. Let's come to the adjustment number 2. Depreciate machinery and furniture by 10% and 5%. They are given. Depreciate is nothing but expenses. Revaluation account always included incomes and expenses only. It won't record it the position statement transaction, that is assets and liabilities. It won't affect it. Here we have to record it only. One is income, another one is expenses only. So here depreciation means it is the expenses to the company. So it is recorded in the revaluation account. Which side we have to record it with? Expenses always come to the debit side and incomes always come to the credit side only. So here they are given depreciate machinery. We have to record it here debit side. 2. Depreciation on machinery. And they are given a first fixed particular percentage. Machinery value they are given. The value of machinery is 20,000 they are given into the rate of depreciation is 10% they are given. We should write 10% or 10 divided by 100. Both are the same. So for the simple calculation we should write directly 20,000 into 10%. So it will come 2,000 rupees as a depreciation of that machinery. So adjustment number 2, first transactions they are given. We have to record it this one. Next, another transaction, depreciate furniture by 5%. Furniture is also asset, so that value is also reduces. So here also we should write 2. Depreciation on furniture. So the value of furniture is 10,000 into 5%. We have to get 500 rupees as the depreciation of the furniture. So adjustment number 2. Once we have to record it, one more time we should record it to the balance sheet. Let's come to adjustment number 3. Provision for doubtful debts is maintained. So in the business they are maintaining some debts will be there that may be doubtful, that may be or may not become. Maybe they will be recovered, means it should be considered as income. May not become, means we should consider as an expenses. Doubtful means, so it should always consider as an expenses. At what percent they are given? At 5% on debtors. What the debtors value will be there, based on that 5% amount may be recovered or may not be recovered. They are given. May or may not be, means it should be considered as an expenses only. So we should write 2 P D provision for doubtful debts at 5% they are given. So which value we are going to define it? Based on debtors. The debtors value is available in the old balance sheet and the asset side. 18,000 5%. 900 rupees as the doubtful debts. So that is belongs to adjustment number 3. That is also we have to record it. Number 4, it will say that appreciate buildings. Appreciation is nothing but income. Whenever it is an income to the company, means that is always come to the revaluation account only, because it deals with income and expenses. So incomes come to the credit side by appreciation of buildings. So some percentage they are given 20%. The value of buildings is 30,030 into 20%. So 3 2s are 6. We have recorded 6,000 as the income to the particular business. And last adjustment is there. Provide rupees 400 for repair charges. So repair charges is an expense. So here 2 outstanding that may be paid in later outstanding repairs. Value is 400 rupees. Yeah. Now we have to close the account. How we are going to close the account? Before closing the account was just we have to go to the solution. Which side we have a highest value? debit side or credit side, left hand side or right hand side. We have to assume that one. If right hand side higher, we have a higher value, then the left hand side means we get profit. If we have to get the debit side highest value, then to the credit side means we can assume we are incurring losses. According to this solution, so which side we have the highest value? Credit side only. The total value is 6,000 rupees. We should record it 6,000 here only. The same value we should record it debit side also 6,000. Out of this 6,000, we should deduct all expenses. We will get profit. So here that profit we transfer to partners capital account. So already I said that. So one account is linked with another account. That link we are going to create it here. So here we should give the name to partners capital account. So here out of 6,000 minus 400 minus 900 minus 500 minus 2,000 we will get 2,200 as the profit. So to partners capital account in bracket which have to mention the profit. So here this profit we have to distribute it according to the ratio of old partners, because the entire incomes and expenses belongs to the old partners only, not for a new partner. So we have to distribute it. Here old partner is Anil and Sunil. So the total profit is 2,200. Out of this profit, Anil share is 3/5, Sunil share is 2/5, because 3:2 ratio given in the beginning of the question itself. If it is not given means we should distribute it equally. If the ratio is given means we should distribute it according to this manner only. The value is 1,220, 320 rupees. Second partner will get 880 rupees. While adding this two, we will get the same value means we have assumed we are distributing in the right manner. If the addition will not be balanced, means we can assume that we are distributing in the wrong manner. We have to imagine. So first account we have to create. Let's move to the second account. So second account is partners capital account. So in the beginning only two partners are there, but after that they are having three partners. We have to preparation of the account of the all the three partners in at a time only. Next account is partners capital account. Partners capital account. We should draw the columns for partners capital account. So we should write the heading debit and credit. For the account it is compulsory. So debit side particulars. So here three partners are there. First partner is Anil. Second partner is Sunil. Third partner is Vimal. Again credit side particulars. Anil, Sunil, third partner is Vimal. Anil, Sunil and Vimal. So these are the columns. So in this account, first we have to record the opening values of the particular account. So in partners capital account, always opening balance comes to the credit side only. So here one doubt will be arises. Why we have recorded the opening balance in the credit side only? Means in the previous balance sheet, the capitals come to our left hand side, that is the debit side. So in the balance sheet we won't mention debit and credit, but we are recording in our left hand side only. Whenever the transactions has been shifted from one account to the another account, the direction will be changed. Left hand transaction recorded to another account, it is come to the right hand side of the particular account. And the right hand side transactions we recorded means it is come to the left hand side of our particular account. So it will be changes its position. So here also we are recording the capital account, we are preparing capital account, we have to record the details of the particular partners, what the things will be belongs to the partner, we have to record it particularly. So here first transaction, by balance brought down. So in the old balance sheet they are given the capital balance of only old partners, that is Anil and Sunil. Anil capital is 40,000. Sunil capital is 30,000, but Vimal's capital is not available in the old balance sheet. We have recorded later. So in the old balance sheet, so partners related transactions they are given. That we have to record it first. Later we should record it come to the adjustment only. So in the old balance sheet, liability side, capitals they are given. That is opening transaction. We have to record it. One more transaction is there in the old balance sheet, that is general reserve. So reserve means they are keeping some amount for future. So here that amount belongs to this old partners only, that we have to distribute it according to their ratios. We should write by general reserve.
4,000.
The value of general reserve is 4,000 rupees. We should write in the column into their ratio is 3:2, 3 by 5 and 2 by 5. So we will get 2,400 for first partner, 1,600 for second partner, third partner will get I-fund. We won't get this value. So any other transaction will be come to the partner's capital in the old balance sheet means we have to record these two transactions. Let's come to the adjustment. So in that adjustment number 1 belongs to the partner's capital account. We should record it later. So here first we should record it by bank account. So here adjustment number 1 will says that he brings rupees 25,000 as capital. He is nothing but Vimal. That transaction, that amount will come to through bank only. We are not taking monetary transaction through bank only. We should record it 25,000 as Vimal's capital. And one more thing, and rupees 8,000 towards goodwill. Goodwill always belongs to the old partners. That good name will not be given to the new partner in present. In future they have a share, but in present year, what the hard work has been done by these two persons, for their hard work, they have to receive some money, that we have recorded here by goodwill account.
8,000.
So the value of goodwill is 8,000. We should distribute it into 3:2 ratio, because if the goodwill brought in by new person is that belongs to only old partners, not for the new partner, we have to distribute this value 8,000 into 3:2. So we will get equal value 4,800, 3,200, and the third partner will get the I-fund. Adjustment 1 is completed. So remaining adjustments will be there, no adjustment. Let's come to revaluation account. In this revaluation account, we have to record a particular word to partners capital account. Partners means who? Anil and Sunil. So what they have to call? Profit. If the difference come to the left hand side, means it is come to the right hand side of another account. Suppose in the revaluation loss we have to get the difference come to the right hand side, we will transfer to the left hand side itself. So here we have to write by revaluation account. From where we get this value we have to get with from revaluation account. Revaluation account. What is this value? We should mention the profit. So that profit already we are distributed in the revaluation account, that is 1,320 rupees. Another one is 880 rupees. That belongs to the old partners only. So these are the transactions which should become to the partners capital account. Adjustment number 2 and 3, 4 and 5 will not affect the partners capital account. That belongs to income and expenses already recorded. So remaining transactions come to this partners capital account. Now we have to close the partners partner. The Vimal, we won't have any other balance. Directly we should write 25,000. And the Sunil total 35,680 rupees. And the Anil's total is 48,520 rupees. The same balance we should record into the debit side also. 48,520, 35,680. Last partner is 25,000. So if anything should be deducted here means we should deduct the value. If it is not possible, we same balance we have to carry forward to balance carry down same values 48,520, 35,680, 25,000. What the balance carries down, that will come to the brought down, because the business is continued. If the business will be wind up, means we won't carry forward. If the business is continued, means we have to forward to some other account. By balance brought down for next year 48,520, 35,680, 25,000. So after transfer of all the balances, we have to close the partner's capital account. The second account we are going to be completed first. So let's come to the third account, that is bank account. So here the bank account and goodwill account, it is not compulsory. If they will ask in the question, then only we have to prepare the bank as well as the goodwill account. Otherwise, we have to prepare only three accounts. One is revaluation account, number 2 partners capital account, number 3 that is balance sheet. If they will ask all the questions headings means we have to prepare in the first question we have to prepare all transactions. Later on by going to the other problematic question we have to prepare only three accounts, that is revaluation, partners capital and balance sheet. Now we have to prepare bank account. So for the bank account also we have the same column, that is particulars amount only. Debit and credit we have to write compulsorily. This is common values, things we have to write. Particulars amount we have to write. Here in the bank account, first we have to record the opening values. So here where the opening value is available means in the question itself, in the old balance sheet they are given cash at the bank. Sometimes they are given cash in hand. Sometimes they are given like this bank balance, cash balance they are given. So that balance will be considered as a opening balance of that account. In the bank account, we won't mention the name bank. Suppose we are preparing cash account means in that account we won't mention cash. Instead of that, we have to record a to balance brought down. Why this value we are recorded into the debit side only means because in the balance sheet the previous value they are given into our right hand side. Now we transfer to our left hand side, that is to balance brought down, which is available in your balance sheet code. The value is 5,000 rupees. It is available in the previously, but after admission we are receiving some values. Which are those values? Means he brings 25,000 as capital and 8,000 towards goodwill. So what we have to done? Partners capital account we are distributed that value. So here by bank account we have recorded, by goodwill account. So or else we have recorded by bank account. In profit we have mentioned goodwill. What is that value? So in the bank account, for where whose account we have transferred? Vimal's capital account, that we have to transfer here to Vimal capital account. we are receiving from Vimal the extra amount in the name called to goodwill account. Goodwill account. So the value is 8,000 rupees. So these are the amount which is available in our bank. So now we are going to total this one. 25 plus 5, 30, 30 plus 8, 38,000. So in the credit side there is no difference we have to get. See, 38,000. So suppose out of these values, any value we are withdrawing means that we have to record it here and we should deduct it. Here no withdrawals. In the adjustment number 1 itself they will be mentioned that goodwill amount is retained in the business. That means goodwill amount should be available in the business only. So the same value we should transfer here, 38,000, by giving a new name by balance capital. Here also bank account will never close. We have to continue the account. So the closing balance will be transferred to next year to balance brought down. Same value 38,000. Sometimes the value may be differ. We have to record it. The differ value also. The third account is also completed. And next the fourth account they are given. That is goodwill account we have to prepare. The next account is goodwill account. Goodwill account. So columns also we have to record it in the same manner. Debit, credit, particulars, amount, particulars, amount. Particulars amount. So here goodwill always begins with credit side only because it is not available in the previous balance sheet. It is comes in the adjustments only. So we should directly record it in the credit side by balance brought down. The value of goodwill is 8,000. This 8,000, what we are doing, we have to distribute it among the partners. So in the goodwill account, we won't get balance carried down and balance brought down according to this question only. Since sometimes it is with half withdrawn is balance carried down, we have to get balance brought down also we have to get. But according to this question, there is no need to create a balance carried down and brought down. So this 8,000, what we have to do with 2. So we are distributing to Anil capital account, to Sunil capital account. We are distributing this value. How we are distributing according to the ratio, that is 4,800 rupees, 3,200 rupees. By adding these two, we will get 8,000 rupees. 8,000 rupees. So goodwill account is not a compulsory account. It is a optional. If they will ask in the examination, we have to prepare. Otherwise, no need to prepare the goodwill account. The first account will have a link with the second account. The second account will have a link for the 2 more accounts. And these 3 accounts will have a link for the 1 more account that will be considered as a balance sheet after admission. Whenever the new partner has to get, during that time, their balance sheet will be like this manner we have to prepare. So that is the final account of the particular question. Next move to the final statement or position statement of the present year. We have to draw the columns for the new balance sheet. Before that, we have to write down the heading balance sheet as on 1/4/2020. After admission of a new partner, their balance sheet will be like this. So we have to prepare based on the assumptions. Based on the assumptions. So here also, with no need to write to the debit and credit, directly we should write liabilities, amount, assets, amount. How the balance sheet is going to prepare? With the base of the old balance sheet and remaining accounts, we have to prepare new balance sheet. Let's come to the old balance sheet. In the beginning, what they are given? The first thing is creditors. So for this creditors, no adjustments will be there, no depreciation, no discounts, nothing will be there. So during that time, we should record the value directly. If any adjustments they are given, we should record separately. What is the value of the creditors? Is
20,000.
20,000. Next, come to second point, bills payable.
6,000.
Value is 6,000. So this is the second transaction. Third transaction they are given in the old balance sheet, general reserve. General reserve belongs to the partners, already distributed. It is added to their capital balances. Now it won't come. So in this year they have maintained any reserve bill, it will come in the future, but present it won't come. General reserve we have to forward it, we have to skip that one. Next point, capitals. So here capital, how many partners are there? 3 partners are there. First partner is Anil, second partner is Sunil, third partner is Vimal. So because he also entered into the business now. So Anil's capital balance already we have to prepare in the account number 2, that is the partner's capital account. First partner capital 48,520. Second partner 35,680 rupees, and the third partner is 25,000. So that is related to the second account. So in the balance sheet nothing will be there. So adjustments we will get come later. Let's come to the asset side. In the asset side, the first heading they are given cash at bank. But in the bank, what is the present balance will be available? Is we have to prepare bank account. In the beginning we have a 5,000. After that 25,000 has deposited by Vimal, and also he is paid 8,000 towards goodwill. It is also available in the business itself. So totally the present bank balance is 38,000. Cash at the bank. From where we have value we have recorded from the bank account brought down left hand side, what the difference we have to get, that will transfer to the right hand side of the next account, that is balance carried down. That will, instead of that we have to write cash at bank only 38,000. Second transaction, debtors. So for this we have an adjustment. The value of debtors is 18,000 rupees is the debtors. For this adjustment number 4 will be there. Provision for doubtful debts is maintained. So we are maintaining the debt. So that value, that is we should consider as an expenses, we should deduct or minus PDD, provision for doubtful debts, 900 rupees. So out of 18,000 we should deduct 900 rupees. Remaining value 17,100 is the value we have to transfer. Adjustment is there, means we should deduct, add or subtract. But direct, if adjustment is not there, means we should write directly. Next transaction, stock. For this, no adjustment for stock. The value of stock is 17,000. We should transfer directly to the balance sheet. Next, buildings. For this adjustment is there. Buildings. The value of buildings is 30,000, which is available into our old balance sheet. For this, we should add appreciation. The value is increased, that is appreciation, 6,000 rupees. Totally 30,000 plus 6,000, 36,000 we have to get. And after that, furniture is there. The value of furniture is 10,000. So for this, depreciation is there, minus depreciation 500 rupees. 10,000 minus 500, we will get 9,500 is the out total value of the particular asset. And finally, machinery. The value of machinery is 20,000. For this, we have a adjustment, that is minus depreciation. The value of depreciation already we should calculate in the account number 1, that is revaluation account, 2,000 rupees as a depreciation. 20 minus 2, we will get 18,000 as a depreciation. And finally, all the transactions we should record it from the balance sheet. Let's come to the adjustments. Adjustment number 1, it says that he brings capital, goodwill. Once we record it partners capital account, second we should record it bank account. That is sufficient. Adjustment number 2, depreciate machinery and furniture. Once we should consider as an expenses under account number 1. Second, we should deduct it from the balance sheet as from their original values, and we have to find out the present value. Next, adjustment number 3, PDD, provision doubtful debts. We should consider as expenses. We should record it the revaluation on debit side, and it should be deducted from the balance sheet, and we have to write the present value. Adjustment number 4, appreciation of buildings. So once we should record it as an income and the revaluation on credit side, and the same value we should add it, and the present value of building is 36,000 we have to get. And last, adjustment number 5. So provide repair charges. We should consider that one is expenses, and finally to transfer to the liability side, we should write repair charges. Value is 400 rupees. Now we are going to total of the balance sheet. If both the sides we get the equal balance, means we will get all the transactions in the right manner. Otherwise, if we get an imbalance, means we should treat it wrongly into the particular transaction. 1,35,600. So here also 1,35,600 only. So like this manner we have to get 12 marks question from the chapter number 3, admission of a partner. So this is about the first question. So let's we have to discuss the different transaction, different assessment in another questions also. Thank you, Ananda.